Hi, welcome to the exclusive premiere of the Black Market panel discussion by Piranha Profits. And can you believe it? It's the 9th year in the making of our Black Market event. So I'm Chi Keng, the host for today, and I'm excited to sit down with some of the best in their respective fields in the studio today, in investing, in trading, in options, and even in crypto. So when you're talking about investing and trading in today's market, we cannot live without this term called AI, or artificial intelligence in short. And in that spirit, I've actually consulted Google's Gemini to kind of give me a broad-based summary to kind of make sense of what's going on in today's market environment. And the summary that they gave me was two very interesting words. It's called profound paradox. Of course, it's a very complicated word. If I can summarize their summary, it basically means that Google Gemini doesn't know what's going on because it's a deep contradiction or a deep conflict. So if I can actually share a little bit more in terms of what Gemini said, I think first things first, we can see incredible amount of excitement in all the AI-related and AI-driven equity gains. Yet at the same time, we've actually experienced some of the most elevated policy uncertainty, with Trump in the White House constantly flip-flopping on some of these regulations and trade tariff positions. And coupled with some of these macro themes like geopolitical tension, the US deficit, and even the interest rate environment. And no wonder even Gemini finds it hard to make sense of the market. But don't worry, we have the experts in the house today to explain to you in greater details. So before we actually go deeper into the conversation, I would just like to remind you, if you're interested in making bigger profits alongside our mentors, you must register to our upcoming live Black Market event with the link in the description below, where the mentors will be sharing with you in greater details their investment and trading strategy. And upon registration, you'll receive a power pack for serious investors and traders that includes tutorials and guides to get you started even before the event. So don't miss that out. So in today's panel, we are featuring the 7 to 8 figure mentors at Piranha Profits. And to lead us off is actually Adam Khoo himself, which I don't think require much introduction, but I think it's still very important to highlight how he's able to build such a large and committed following. It's really his superpower in being able to break down complex topics into easy to understand tutorials and guides for the layman investor. So to kickstart the discussion, Adam, maybe you want to share with the audience what's your investing and trading methodology in a nutshell, and how have you done so far in 2025?
So this year has been pretty profitable so far across my different strategies. My main strategy is, of course, investing in stocks. And I've actually got two ways I do that. One is my capital gain portfolio, where I primarily invest in US stocks for capital gains, as well as my dividend portfolio, where I focus on companies that pay a high dividend yield. And I also trade stocks and options at the same time. My main approach is what I call value momentum investing, where I only invest in the highest quality businesses. And I only buy them when they're undervalued. I've been in the markets now for over 30 years, started trading and investing at 17 years old, and in fact have been teaching this since 2005, over the last 20 years. And back in 2016, started the Piranha Profits online financial trading school. Year to date, my performance is up over 21%, outperforming the S&P. In terms of dollar gains, I'm up about 2.3 million US dollars. And many of you who are in the Ultimate Investors Playbook that's tracking my portfolio, since 2019 January to now, the last now close to 7 years, the portfolio is up 277%, versus the S&P, which is up 171%. So that's roughly a 22% compounded annual growth rate.
Right, Adam, that's great to hear. Maybe you can also share a little bit more in terms of what are your notable wins this year, the greatest gainers, and maybe some of the detractors as well.
So yeah, it's very obvious that the stocks that has given my portfolio the greatest gains are the AI-related stocks. So Nvidia, Palantir, but some non-AI stocks as well have done pretty well, like Celsius has also done very well, and others like Broadcom. So these are the main ones that have given me the biggest gains in the portfolio. And of course, Amazon and recently Google.
Right. Thanks, Adam. So moving on to Bang. So Pham Van is actually the options trading master in Piranha Profits. So maybe just to kickstart the discussion, Bang, how have you did this year? And maybe just to share and to follow up from last year's event, I know you have just retired as well. So maybe you can share a little bit in terms of how you're spending your time.
Yeah, thanks, CK. My name is Bang Pham. I'm option trading strategist at Piranha Profits. And I've been trading for 25 years, including more than 20 years of option trading. As I shared last year in this panel, I have retired from my main day job to focus on helping Piranha Profits community, and based on what our students shares in the Discord channels, many of them had made loads of money taking advantage of this incredible run of the market. For me, myself, this year, 2025, with 10 months being passed, it's been good. So far, I have generated 23% return on investment. In terms of absolute dollars, it's about 800,000 US dollar in profits, right? And if I look back over the past 3 years since I retired, I have earned approximately 4 to 5 times of my annual income from employment, so in trading profits, right? So every year I got about 4 to 5 times of profit compared to my employment income, which had been good. And this year, my biggest wins include NVIDIA, Amazon, Tesla, and gold. So those are big names that I've been trading. And specifically for 2025, I've been using this C to D option strategies that allow me to profit massively from the market run. And I will share the detail later on.
Okay, thanks, Bang. So last but not least, we have Alson. So Alson Chew is a former award-winning prop trader. And I think throughout his entire trading career, he has amassed more than 10 million US dollars in trading profits in total. So maybe Alson, just to give a quick introduction to the audience, your own trading methods and how you have done so far in 2025.
So hi guys, I'm Alson and I'm the principal trainer for the price action manipulation program in Piranha Profits. So I specialize more in short-term trading and swing trading in stocks, forex, futures, and even cryptocurrencies. And one fun fact, when I was in my university days, I actually studied business IT. But instead of joining the IT profession and working in the IT firm or even in the bank, I actually took up the opportunity to join a proprietary trading desk, where I actually work full-time as a proprietary trader. So during my time in the prop desk, I actually achieved the top trader award twice in a row, made about $1.2 million of net profit during my time in the desk. And that's also where I also have the privilege to work and trade alongside with some of the top traders in the industry. And I learned more about market manipulation during my time there. And over the years, right, through my experience trading the markets, a lot of trials and tribulations, right, mistakes and observations, I developed my unique style of trading called price action manipulation. And this strategy helps me to identify and trade market manipulation. So year to date, my performance so far this year is up around 60%. And I started the year with about $2.3 million of portfolio across stocks and crypto. And I made about $1.4 million so far.
And Alson, what about some of the notable wins under this 60% return this year?
Okay, so some of my notable wins in the stock market is, one of them is Tesla, where I managed to catch the bottom during the China-US trade war in April. And now it's almost double my entry price. So I made about a 6-figure profit in Tesla. And also in crypto, even though this year has been quite a rough year for cryptocurrencies in general, I managed to catch some winners in certain odds like XRP and Zcash, where I made 8 to 10 times my money so far. So in today's Black Market panel discussion, I look forward to share with you guys more about my experience in trading and also my views in the market as well.
So with all the trainers' introductions out of the way, I think I want to set a little bit more context to ground our entire discussion. So I think 2025, like any other year, have many developments in the financial markets. But I think if I were to cast your memory back over the last 10 months, I think it's quite clear that one major event is still stuck in our memory, at least in our short-term memory. It was what happened during the April Trump tariff crash, or some of you might call it the Trump tariff tantrum. So back then, I think we've seen major indexes all suffered pretty huge drawdowns. And the SPX, which was tracking the S&P 500, was flirting with the bear market territory. It didn't close down 20%, but it was pretty close. But the Nasdaq, or the triple Q, which tracks the Nasdaq, was down more than 20%. And I think against this backdrop, actually one of the critical themes that we are talking about here today is AI, artificial intelligence. And according to JP Morgan, since 2022, 75% of the index gains were actually driven by this group of stocks in this AI arena or agenda. And to give a quick summary of the general market performances. So the SPY or SPX is up 16% year to date. The triple Q or the Nasdaq is up 23% year to date. China, the Hang Seng Index is up 32%, and the CSI 300 that tracks the mainland A-shares market is up 21%. So looking at the two largest markets, US and China, looking pretty good so far this year. And even coming back to home, our local market, the Singapore Index STI, is up 16% year to date, and they are now all-time highs after a very long sideways market. And to bring a much more global perspective, the MSCI World up 19%, the emerging markets up 32%. Gold, that Bang was talking about, is up 50% year to date. And of course, a very similar asset, which is under the hard asset class, Bitcoin, not as well as gold, but still up a respectable 17% year to date. So I think the biggest opportunity cost, especially for investors, are those that were sitting on the sidelines because they were afraid of many of these narratives. A recession is coming, Trump doesn't know what he's doing, and if they held onto cash alone, I think they basically missed that entire bull run. And following up from last year's event, we had the mother of all rally. I think it's shaping up pretty well this year alone. So Adam, I think everything is literally going up. And I believe many investors and traders alike are constantly asking, what's happening? How should we understand this? Can you help us make a little bit more sense in this current market environment?
So why has the market gone up this year? Well, first of all, remember that over the long run, the market goes up 78% of the time. Okay, so this year, the fact it's up is again out of the 78% of the time, right? But it's very obvious why the market went up this year. Remember that ultimately there are four things that drive stock prices. Number one, earnings growth. Number two, dividends. Number three, share buybacks. And number four, money supply. So the first thing is earnings growth. And this year, the reason why the market has done so well is because the companies within the S&P 500, especially those related to AI infrastructure and AI software, have delivered very strong earnings. Like just recently, last week, again, Amazon and Google, for example, had blowout earnings. So when companies make more money, of course, they are worth more and the share price goes up. So earnings have driven this market higher. So when people say, oh, it's a bubble, I don't think so. Because bubble means that the price goes up, but the earnings don't follow. But in this case, it's earnings that's supporting the price. And number two, companies are paying more dividends. And number three, companies are doing share buybacks, which is a good thing because when companies buy back shares, they are returning capital to shareholders. And the fourth thing is increase in money supply. Well, there are two ways where the Fed increases money supply. Number one is they cut interest rates. Number two is they buy back bonds. And they've only done the first thing so far. So we know that the Federal Reserve, after raising interest rates aggressively in 2022, they have been in a rate cut cycle. So as the Fed cuts interest rates, although slower than expected, that drives markets higher. But they have not been buying back bonds. They have been doing quantitative tightening, right? Which means they are actually restricting the money supply. But in fact, from 1st December onwards, they're going to start doing quantitative easing. They're going to start buying back bonds, which means that money supply is going to be even stronger. So because of that, it's very obvious why the market is going up. Because again, you've got earnings, you've got dividends, you've got share buybacks, you've got money supply. That's why it's going up. Very obvious, right? And of course, the other reason it's going up is because China has also started recovering strongly. Now, the Chinese government has been very pro-business. They are making friends with all the capitals of industries, and they are doing a lot of fiscal stimulation, monetary stimulation, and earnings have begun to recover in Chinese companies. So that's also pushing up global markets. And the tariffs have been shown to be not as scary as people expected. So initially when Trump came out and imposed 100% tariffs on so many countries, people thought, oh, we're going to die. But all along, it has been a show. remember that Trump was a reality TV star. He's a showman. So he does all these things for shock effect, and it's a negotiation tactic. So if you know that ultimately Trump wants the market to go up, right, you should use these shocks as a way to add more shares and take advantage of people's fears, because ultimately he's going to make the market go up because that's his number one agenda. In fact.
How about maybe just to share a little bit in terms of teasing the idea, because we've seen this recent term called taco trade, right? Trump always chickening out.
Yeah.
Just wanted to get your thoughts on, is there really an elevated level of policy uncertainty, or should investors just treat these as life still goes on?
Okay. So one of the things that I learned from the greatest investors in the world, I learned from Warren Buffett, Charlie Munger, and Peter Lynch, is that in investing, you totally ignore the macroeconomics. You ignore interest rates, inflation, you ignore all these things. Now, is it that it's not important? No, it is important. But why do we ignore it? Because it is unknowable. It is unpredictable. So there's no point focusing on something that you can't predict, right? Instead, we focus on things that we can understand, which is the business making more money? Are they selling a product or service that everyone needs to use? Like everyone has to use Google, right? Everyone has to use Microsoft and so on and so forth. And as long as we focus on companies where, the products are used all the time and we buy them when they're undervalued, we will do very, very well. All right. And ultimately, like I said, when you ignore the macro and focus on the businesses, you will do very well.
I think the emphasis here is also more about time in the market.
Yeah,
it's more important.
Absolutely, right? So one thing I've said again and again for so many years teaching the students is that time in the markets is more important than trying to time the markets. If there was a famous study that I talked about many times in my YouTube videos that even if you're the most unlucky market timer, where you keep buying at the top and you buy just before a crash, even if you do that, in the long run, you will still make more money than someone who doesn't even start, who waits on the sidelines in cash, waiting for the market to crash one day. That guy will end up the worst result.
Right. Thanks, Adam, for the summary. So now let's move on to Elson. So Elson, when looking at the current price action of the general global asset classes, can you give us a very quick overview into understanding where the market is at today?
Okay, for the US market, I will look at the S&P 500 on the higher time frame, for example, the weekly chart. That's how I analyze the overall health of the US market. So right now, the weekly chart in the S&P, I would say that there is no technical signs of top. So when I talk about signs of top, we are looking out for things like a exuberance, like a flush up or outstanding green flush up bars, big green bar range. So we are not seeing all this price action in the market right now. Instead, we are seeing a very gradual increase in price. We call that a slow wave up. And the slow wave up in price action is actually healthy for the markets. So actually my view of the stock market is that even though it's very tempting to short, because the chart is on the top right-hand corner of the chart, right? It looks like it's likely to go higher towards the end of the year. So I'm taking that bullish view right now.
How about the other major index, like let's say the Hong Kong or Chinese market?
Right. So similarly, I think the China-Hong Kong market, right? I mean, for the Hong Kong market, I'll look at the HSI, Hang Seng, and this year Hang Seng has actually the price action has moved above the 50 and the 200 SMA for the first time in the last couple of years. In fact, right now it's the same thing as the S&P 500. There's no signs of top, right? We are not seeing any exuberance. The price action is rising gradually. We call it a wave up as well. So I do see that the China market, because it has been suppressed in the last few years, it's emerging from a downtrend to an uptrend. In fact, I think we are in the early stage of the bull run in the Hong Kong China market.
I think last but not least as well, a lot of people are interested in the gold trade, right? Because gold has been, if not one of the best performing asset classes year to date. So how about the gold chart? People are saying that maybe we are seeing some sort of an exuberance already and the idea of a debasement trade. Maybe you can explain a little bit more about gold.
Okay, for gold, I will talk about it in terms of the technicals and the fundamental perspective. So gold is, fundamentally, we take it as a debasement trade. because we all of us know that the US, the debt to GDP ratio is about 124%. So the US do have to service a high amount of debt, and to do that, taxes are not enough because they are spending more than the tax received, right, every year. So what the US do is they will have to expand the monetary base and inject liquidity, print some money to service the debt, right? And especially starting December, as Adam mentioned, right, they're going to go into quantitative easing. So when this happens, right, naturally the purchasing power of the dollar will drop over time, right? And there will be increase in inflation. Our purchasing power will drop, and people actually would want to buy hard assets like gold, right, to hedge themselves from inflation. But recently, because gold has risen up very strongly this year, right, in terms of price action, the chart has started from a wave up, just like S&P and Hang Seng. But in the last couple of months, it started to do what we call a flush up. Means there's some form of exuberance, right? I believe you have met your friends or relatives going to the pawn shop or the gold shop to buy gold, right? There's certain fear of missing out going on, right? And technically, right, it also tells the same story. I think a lot of retailers are FOMOing to the trade. And I think that in the short to medium term, there should be some form of sideways to downside price action. But in the long term, I see that gold is not likely to do a major crash anytime soon because of the fundamental tailwind, right, that gold has right now. So I'll be looking out for technical entries using the bullish PAM structure to get in if gold form a setup.
Thanks, Elson. And since we are already on this topic of gold as well, right? Adam, I'm sure a lot of investors are probably knocking on your door asking you whether if we don't have exposure, should we start to add some exposure in order to not miss out this huge run? Or what do you think about gold today?
So it's the same question people ask me, Adam, why don't you buy gold? Why don't you buy crypto? Why don't you buy paintings? Why don't you buy Rolex watches and stuff like that, right? And of course, there's nothing wrong with that. You can make a lot of money from that. But, I tend to like to invest in assets that I can value, right? And to me, the only accurate way of valuing something is if there's cash flow, if it produces something. Because to me, the way I calculate intrinsic value of an asset is based on the discounted future cash flow I can generate from it. That's why I like stocks, I like real estate or REITs, because I can calculate the valuation. But things like gold or crypto or paintings or stuff, I can't accurately value it. So when I can't value it, I can't tell is it expensive or cheap. All right. So because of that, I tend to stay away from unproductive assets, and I focus on productive assets. And of course, are there some unproductive assets like even Pokemon cards that can go up a lot? Sure, right? And is it okay for me to miss out on those gains from Pokemon or Go? Yeah, right? Because if I can make a few million doing what I feel comfortable with, I don't have to win at every game. I just need to win at the game which I'm comfortable at playing. Because to me, when you buy a non-productive asset and it goes up, sure, no problem, right? But what if it doesn't go up? What if it goes down? Then you've got no idea how low can it go, can it come back? You don't know. Because the price of these non-productive assets are purely psychological. It is worth what people think it's worth. And for me, I feel very uncomfortable with that because I can't predict people, right? But when I buy an asset where the value is based on cash flow, that's something I find easier to predict and easier to value. So when I buy a productive asset like Microsoft or Google, and if the share price drops 20-30% in the short term, I've got no worries. Right? Because I know it's producing the cash and it will eventually get back above the valuation.
Yes. Thanks, Adam, for sharing. So Adam is not going to touch gold anytime soon. Yet at the same time, we have Bang making a killing with the GLD ETF that tracks the gold price. So Bang, maybe just to share a quick note to the audience of how's your experience trading around gold and what was the trade setup like and how much money you made?
Yeah, so I can understand what Adam just said. Right? He's talk more on the investor standpoint. Because he normally buys something that he will hold 5, 10, 20 years, right? So it doesn't matter the price fluctuation in the short term. But as a trader, I don't really care the fundamentals of gold. I don't know how to value it, as Adam said. As long as it has good structure or I'm trading options. Option on gold has been very good this year. And there was a time when gold was like going sideways for many months. I think it tested the resistance level and attempted to break out many times in the year. And that is a very good setup for what I call it C2D strategy, where I use calendar spread. So the stock price kept going in a sideways consolidation pattern. And that is a very good setup for a calendar spread where I am paid to wait. So I don't care how long it takes for the price to break out. I'm paid to wait, so I keep staying on the trade. And because the option premiums are so good, I'm paid to wait for many months until it finally broke out. And that's when I converted my trade into a bullish trade, which is diagonal spread, and ride on the uptrend. So C to D, calendar to diagonal spread, is one of the strategies that I've used on gold this year and make a killing, as you say it, on gold. Again, I don't care much on the fundamentals as long as the trade has a good premium for me to collect. And also, when the trend is up, then I convert it to a more bullish trade to ride on the uptrend. So that's what I have done for gold.
Right. So for this C to D strategy that you talked about, in terms of the payout or the representation of your profits this year, how much does it represent? And maybe you can share a little bit more.
So for gold itself, I use C to D, but I also use other bullish strategies, and I make like 1/3 from the C to D, 1/3 from crouching bull and other proprietary strategies that I've been using, and the other bullish strategies I use for the other 1/3 as well. So gold has been a big chunk of my profit this year, but in terms of strategy, I use 1/3 on C to D.
Right. Thanks, Bang, for sharing. So maybe now let's move on a little bit. Let's do a reflective state for 2025. Maybe Bang, then I'll let you kickstart the discussion to understand maybe what are your biggest surprises or lessons learned in 2025 alone.
Yeah, as you mentioned earlier, obviously the Liberation Tariff Announcement Day is a big event. Now, the event itself is not a surprise because people know that event has been scheduled in advance. Everyone knows Trump's going to announce something. The thing that surprised me was the magnitude of the market reaction, right? The fact that the market fell very sharply many days in a row during that period of time when people thought that Trump was like destroying the whole world market, right? Of course, I went through drawdowns, a big drawdown during that time. And my approach at that time was, okay, whatever trades I was in and it hit stop loss, I get out. That's not a good thing about trading, right? Once you're out, you can sleep very well. You don't have to think about the trade when the next day could be another decline, right? So it's like death by 1,000 cuts. So in trading, once you're out, you're very peaceful. You can sleep well. I purposely reduced my exposure during that time to manage the risk on the downside. So that's the first surprise. But I managed the risk to make sure that I still preserve my capital for the bullish day. And the second surprise was the sharp recovery from that selling. That's where I positioned myself in a way that I was very nimble to jump right in when the bull market returns and ride on the uptrend and make all the money back and even more. That's why I shared the result earlier, despite the big decline or big drawdown during the Liberation Day. So the lesson is you need to be very nimble and keep your mind open so that you always like be there in the market when it's there for you to reap the benefit. So again, during that Liberation Day sell-off, right, a lot of my trade get stopped out, but the loss are limited because I use calendar spread and it limit my downside risk. And I normally cut loss at like 50% of the max loss. So because my trades still normally have a longer day to expiration. So a big sell-off hit my stop loss at 50% of the max loss. I did not lose 100% and I preserve my capital. But when the bull market returns, I ride on in and many of my trades made like 50, 100% return and that covers on the losses and even more. So C2D is one of my main strategies I've been using in this year. It's very powerful in terms of limiting the downside risk in case that kind of event happen, and then ride on the uptrend and gain on the money back when the market returns. So that is a powerful strategy that I plan to share in the upcoming live black market online event. If you are interested in knowing the details, register in the link below.
Okay. Elson, what about yourself? Biggest surprises or lessons in 2025?
So 2025, I think, is a year where I think all traders have to really look out for the top AI names, right, to see if there is any bearish pattern in some of the top AI stocks like Nvidia, right. So earlier this year, right, in 2025, right, I actually, during one of the market outlook event, I actually spotted a bull trap pattern for Nvidia, and that actually makes me cautious for the first quarter of the year, right, because the bull trap pattern is actually a very bearish pattern, right, that tells me that some traders are being caught on the upside. And true enough, right, Nvidia's stock actually retraced from the start of the year until it reached around the $90 level. And the sell down is also, of course, due to the China-US trade war as well. And since then, in April, there was a rebound, and Nvidia actually did a bear trap, which is bullish. And that's also how the entire market recovers. So a key lesson is that if I want to know whether the AI sector is toppish or the market is going to retrace strongly, I will watch the price action of the top AI stocks.
So when talking about these top AI stocks, right, maybe other than Nvidia, are there multiple names that are on your watch list that you tend to monitor their price action very diligently?
So I think some of the key names in the AI sector is also Palantir, and I will classify Tesla as one of the top AI stocks as well. So I've been monitoring all these stocks and trading them. If they form a key signs of top, right, on the higher time frame, and that's where I will start being cautious on the entire market.
Right. So if I can summarize, it means that you are monitoring like the bellwethers, the leaders of those space, and once their technicals start to not look so good, it might mean, or it might signal something worse for the entire sector.
Yes, because like the AI companies are really the drivers of, I think, most of the returns in the S&P 500. So if the leader is not doing well, then the soldiers will usually suffer, right? So I do monitor them very closely. So in my upcoming Black Market live online event webinar, I'll be sharing with you guys how I spot market manipulation, right? And who are the market makers, how they manipulate the public, doing things like candlestick printing, how they squeeze retailers, right? And clear their stop loss before the price move higher and things like that, right? So I'll also be sharing a generic form of market manipulation strategy called bull and bear traps with multiple examples during my webinar as well. So if you're interested in the webinar, click on the link below and register right now.
Thanks, Elson. So last but not least, Adam. So what are the biggest surprises or lessons learned in 2025?
So if you guys recall, last year during this black market panel, as well as early this year during our Outlook event, I said that I expected that 2025 will be bullish because of the AI revolution, because of Trump deregulation, tax cuts. All signs were pointing to a bullish year. So of course, I was surprised like everyone else in March, April, when we had that big drop in the markets because of Trump coming up and talking about Liberation Day and slapping all the big tariffs. So that was definitely a surprise, right? But again, when it went down, a lot of institutional investors actually cut loss, right? They sold at the bottom of March. Some of them even shorted the market, and it was surprised when the market rebounded back very, very strongly. But from my experience, I knew that every time the market drops very strongly, it will bounce back very, very fast, especially if the initial drop was caused by a narrative and not actual deterioration of the fundamentals. So when the market dropped at that time, I told my students, I said, well, take a look at the companies that we own. Are they making less revenue? No. Are they making less profits? No. They're still making revenue, still making profits, right? So the price drop was purely psychological. It was purely emotional. It was nothing fundamental. And that time, a lot of the economists, they were saying that, oh, because of this, the economy will go into recession. And I think a lot of them, they thought that, Trump is doing something crazy, But one of the things that I learned from the past was what happened in March 2020 after the COVID crash. Most of the economists said that we're going into a depression. And a lot of people panic sell in March 2020, and that was the bottom of the market, And then they made the same mistake in 2022. When the market dropped in 2022 because of the Fed raising interest rates, economists said 2023 will be a guaranteed recession because the interest rate hike will crash the economy. Again, it didn't happen. 2023 was a bull market. So, like what Peter Lynch and Warren Buffett has always said, they have never met a rich economist. All right, and you should never listen to all these economists because no one can predict the economy. Instead, again, look at the companies you own. Are they making money? Are they undervalued? If they are, you just buy, right? So that's what I did with my students. When the market dropped in March this year, I said, you know what? Let's keep adding or holding the good companies, and we did, and we made huge returns this year. So again, it's a lesson we have seen so many times. It's the same movie being played again and again. You learn from the movie, you apply the same thing, and you do very well.
I think also one very important difference or transition this year was the new incoming president, right? Yeah. I think there were a lot of rumors and discussions about how Trump might be bad for the economy. He's doing a lot of all these very messy things. Yeah. So I just wanted to get your thoughts about this new transition as well. And I do know people sitting on the sidelines just because they don't like the president. Yeah. So how do you see this?
So I think one reason why a lot of people lost money, and not just retail, I think, in fact, a lot of the institutional investors and hedge funds. In fact, there was a recent report that only 22% of active fund managers beat the market this year. Only 22%. That means almost 80% of fund managers did not beat the market this year. Why? Because a lot of them have this thing called TDS, the Trump derangement syndrome, which means they don't like Trump. And because they don't like Trump, they allow this belief to cloud their perception. And they think, Trump will kill the market, he's bad for the market. And because of that, they didn't buy stocks. They shorted the market because of their political bias. Now, I'm not saying that I love Trump, but what I'm saying is that to be a good investor, you cannot allow your political biasness or any kind of biases cloud your perception. You have to look at it very objectively with no emotions and no biases, and that's how you make money.
So I agree with you, Adam. I think that's my lesson back in late 2016 and 2017 when Trump won over Hillary Clinton. And I was in that camp. I was thinking about, hey, how Trump could be good for the world, right? So in the market rally, I say it must be a fake rally. So I did not cut losses on some of my trade because the rally, it caused losses. So I let it run and then hit max loss most of my trades.
Because you were short.
Because
you were shorting.
So I trade on iron condor.
Yeah.
And if the market went up so much, then it did not sit well for the trade. I did not cut loss because I thought the rally was fake. And I was so biased, as you say. And that hit my portfolio quite badly during that time. So that's a lesson that I learned back almost 10 years ago. Right? So I totally agree with you. We should not be biased and let it cloud our decision. We need to be nimble and be open-minded. Yeah.
So for me as well, I focus more on the price action, right? Sometimes, right, even though there's bad news, I may still enter the trade if there is a valid trade setup. And I always tell my students is that when we are trading market manipulation, right, we will never know the black box, what's inside the black box. So the true intention of the big boys or the market makers is like a black box. You will not know why they buy. Are they accumulating the stock? And sometimes by the time you know the real reason why they accumulate the stock price goes up, it will be too late. So one lesson I learned is that if the big boys or the market makers are accumulating the stock or they are buying, we should just follow them. Because there's only one reason why they buy. They believe the stock price will go up or they want it to go up. And we don't fight them, right? We are supposed to follow them as traders to gain the strongest edge in the market.
So I totally agree with what Elson said. And as you guys know, although I'm more of an investor versus a trader, but I also use a lot of technical analysis in my investments. So if I like a great company that's making money, fundamentally, I still look at the price action, right? And again, when I said the fact that when the market crashes and we keep holding or adding stocks, it must only be the highest quality stocks. So like I've said many times before, if you look at the whole market, I will say that only less than 1% of stocks are high quality companies. They make consistent profits, they've got strong economic moats, they've got high return on capital. And these are the only stocks that we should invest in. 99% of stocks, to me, are uninvestable. Okay? You can trade them short term, yes, but to invest long term, it's very risky because their profits may not be sustainable and they may be very overvalued. So again, we only want to add and invest in the top 1%. And if you're wondering, how do I find the top 1%? They meet certain criteria. They have certain characteristics. So during the black market event, during my webinar, I'll be sharing with you what are my criteria for finding the top 1% of the high quality stocks in the world. So if you're interested, again, you can click and register in the link below.
Thanks to all the trainer for sharing and your reflections for 2025. So I think for most investors and traders listening in to this panel discussion today, they want to know the now. So what am I supposed to do now? And I think one of the biggest questions that we seek to answer, at least in today's episode, is really understanding where the current state of the market is, and to try to tackle this question head on whether we are currently in an AI bubble or not. So to just cite a few numbers to give you a bit more perspectives, I think valuations today are starting to look a little bit stretched. So you have 30 times PE, price to earnings, becoming the norm for many of these companies, especially in those in the AI sector. So you also have phenomenal amount of spending. You see many of these big tech companies spending cumulatively hundreds of billions of dollars on a quarterly basis. And in the latest disclosure, I think it adds up to roughly $380 billion on an annual run rate basis. And on top of that, you also start to see increasing amounts of speculative behaviors, especially for companies that probably don't even generate any amount of revenue, yet they have tens of billions of dollars in market cap. And of course, we do see some of the AI and tech leaders coming in, saying that there might potentially be an AI bubble. You have people like Jeff Bezos, even Sam Altman and Pat Gelsinger. So I think the largest question that we want to tackle today is, how do you trade and invest in an environment like this? So maybe you'll get Bang to kickstart the entire discussion. How do you trade in this entire AI bubble narrative?
Yeah. So people keep talking about AI bubble or overvaluation. I really don't care as a trader, right? Interestingly, because of the high volatility in those names, the stock itself have very good option premiums. And as a trader, I love it because then I could use a C to D strategy I talk about. Started as a calendar spread, have very good protection on the downside if the stock price falls. If the stock price goes sideways, I'm paid to wait. And again, premiums are good, so I'm paid a lot of money to wait. And if the stock price rallies again, okay, I can always convert my trade into a bull run, bullish market, bullish trade, right? So these are the names that I love to trade on, and I don't pay much attention on the valuation of those stocks itself because my trades are risk defined, so I know exactly how much my max loss in case the whole thing collapses, right? But if I'm right or if the stock price goes sideways, that is the best thing that happened to my trade. So love it.
And guys, those of you who are watching, some of you may not realize that Bang, together with myself, the way we trade options is different from most people. Most people, they tend to be net buyer of options, where they pay the premium. But for Bang and myself, we tend to be net seller of options.
Correct.
We tend to sell options more than we buy options. So it's a very different approach from most people.
Very good reminder. I am not like buying a call option and hope that it will go up in the value tomorrow. No, that is the wrong way to trade, right? Trading option, you need to know you better a seller than the buyer so that you can take advantage of premiums and also the whole structure of the strategies.
Yeah, so we sell options to people who buy options.
That's right.
Yeah.
The other side of the trade.
Yes, Bang, maybe you can share one of those specific case studies when you're talking about this C2D strategy, and especially on those that have high volume or good premiums to collect.
Yeah, so not only like AI, but things like Bitcoin or Ethereum, ETF, or digital companies, right? Those are the ones that have very good premium. So for example, I also traded the stock called Bitmine, BMNR. So this is a stock that moves a lot, but has also very good premiums. So even when I enter it, the stock price drops significantly, my calendar spread would still very profitable. And then when it rallies, I ride it on the uptrend and make tons of money on that one. And I have traded it many times. Other names that I have traded, including Circle, right? Circle, and then Bitcoin ETF like IBIT, or Bitcoin ETF leverage like BITX. I also trade like CoreWeave, the AI stock, and also, of course, NVIDIA and Palantir. Those are the things that I've been trading as well.
Right. So for these names especially, is there anything in particular that you're looking out for? Walk us through one of the case study, like let's say CoreWeave, for example.
Yeah, so again, not much on the fundamentals. Just look at the chart, the price pattern. So if it like after a pullback and hitting some support, and I construct a trade that has limited downside risk, but tremendous upside potential, and if the stock price doesn't go anywhere, it's still profitable. So that is the setup. Normally I look at the risk-reward ratio and the technical support or resistance to set up the trades. Not much on the fundamentals.
And for those of you who are not sure what's a calendar spread or diagonal spread strategy, that's what Bang is going to teach in his webinar. So
correct.
Do watch his webinar to learn what he means.
Yeah, we do the live trading on the Trade Hunt as well. So where I will use my real money to trade in front of you. So that's what's going to happen.
Yes, and the live Trade Hunt is part of the series of webinars that we offer in the black market event itself.
So one of the example of trading this AI-driven stocks is one trade I did on Meta. So I remember on that trade when I entered, when the stock price was trading at about 750 level. And then I entered the trade as a calendar spread, expecting the stock price to go higher from there. But I was wrong. The stock price actually declined after my entry point. And the stock price dropped like 35 points. Yet my trade is not losing. I think barely lost a few dollars on the trade. And then it drops even more. It went down to like $6.95 or something. And my trade lost about $100. That's it. But then I kept rolling my trade, buying more time, collecting more premium to cushion the downside risk. And eventually the stock price recovers to 720, 730, and my trade started making profit again. So by the time I exited the trade before the earnings, the stock price was still below my entry point, yet my trade made decent profit. So that's one example. Similarly, on the CoreWeave, I entered the trade and the stock price kept going down, and I kept selling more short-term premium, and my trade stayed profitable. And then when the stock price recovers, I made good profit. I think that one hit my profit target and also exited the trade. So that's the way you use C2D strategy to benefit from different market directions. Down, sideways, and up isn't better.
So that's the one advantage of the way Bang and myself we like to trade options is we don't have to be right on the direction.
Correct.
Even if the stock doesn't go in our direction, we can still make money, right? Because of the way the trade is constructed.
That's right.
Okay. So now moving on to Elson. So Elson, how do you trade in this current AI bubble narrative?
I think the AI narrative will continue towards the end of the year and even in 2026. So I'll be looking out at the technicals of some of the AI companies, right? If there's certain retracement, I'll be looking out for bullish price action manipulation setup to enter them. And also, my focus, actually, I give more preference to speculative growth companies because some of them can deliver in the short to medium term 50 to 100% returns. So there are sectors like crypto treasury companies like BMMR type of companies, MSTR. If they form a bullish price action manipulation setup, I will be looking to get a position in them as well. Yep. So I also trade like Bitcoin ETF, right? Like the IBIT, and also stocks like Tesla. And when there is like a major retracement in the market, like what we see earlier this year in April 2025, the China-US trade war, I took on some significant position in Tesla Bitcoin ETF when they form a certain bear trap pattern, right? That tells me that market makers are accumulating the stock. Right, so I'll be taking on such positions towards the end of the year and next year as well to capitalize on any upside move in the markets.
So that's on the trading front. So how about for investors, Adam? When they're looking at this monster called a potential AI bubble, how should we look at it as investors?
So a lot of the news you read, they talk about bubble market overvalued, and you should know by now, don't trust the media, okay? Use your own or do your own research. And so first of all, why do some people say that there is a bubble, right? They look at things like, again, PE ratio or the Buffett indicator. And first of all, if you look at PE ratio, the forward PE ratio of the S&P is now about 22 to 23 times earnings, which is above the 10-year average of 19 times earnings. So if you compare the PE today with the history, yeah, it looks above the average, right? But again, you can't compare today to the past, the same PE, because companies today, their earnings growth is much higher than 10, 20 years ago. And the company's profit margins today are much higher, in fact, are double the profit margins of 10, 15 years ago. So using PE itself is very misleading. All right. What is more accurate is to look at what we call the PEG ratio, which is the PE ratio divided by the earnings growth rate. And if you look at that metric, the market is actually not expensive. The current PEG ratio now is 1.3 something, all right, less than 1.4. And if you look at the dot-com bubble, the PEG ratio at the time was something like 1.5, 1.6. In 2016, it was also about 1.8. Before the COVID crash, it was above 2. So looking at the PEG ratio, the market is not very expensive, okay? But what is even more accurate, and what I do with my students, is we do a bottom-up approach. That means we calculate the intrinsic value of the individual companies, okay? Using a discounted cash flow valuation, and that's more accurate. And from that method, we found that in the market today, about, I would say, yes, half the stocks are expensive. About roughly 50% are expensive. 25% are fairly priced. Not cheap, not expensive, fairly priced. But there's 25% that are actually very undervalued. So the whole key is, how do you know what are the 25%? So that's what I'm going to cover again in my webinar. And within the 25% that are undervalued, you only want the high quality ones. So what I'm saying is, even in today's market, when it's near all-time highs, there are very good deals around. All right? And you have to know how to find them, and I'll show you how I find them in my coming webinar in Black Market.
So maybe on this note, right, really a lot of investors are afraid of whether they have too much AI exposure. So Adam, for yourself, maybe you can share a little bit more in terms of your portfolio allocation today on what is related to AI and not, and what's your thinking behind them.
Right. So again, for me, remember that I've got my capital gain portfolio where the objective is to grow my wealth at 20% or more a year. And I've got my dividend portfolio where the objective is just to collect dividends. So for my dividend portfolio, it's zero exposure to AI, right? Because again, the objective is to get dividends and not to grow. Now, for my capital gain portfolio, roughly I would say about 35%, 1/3 of the portfolio has exposure to AI, okay? And out of that 35%, about 15% are directly exposed to semiconductor stocks like Nvidia and Broadcom and so on and so forth. Okay, so only about 35%. And overall, my portfolio, about half are related to technology, right? So not just AI, it could be cybersecurity, could be software companies, and 50% are non-technology companies. Healthcare, industrial stocks, consumer staples, consumer discretionary, and so on and so forth. So I'm pretty well diversified because I believe that, to be a successful investor, it's not about predicting where the market is going in the short term, because it's impossible to predict, right? Will there come a day when all these AI stocks have a big correction? Yes. When? I don't know. Could be next month, could be 2 years from now. I don't know when, but it will happen, right? So the whole idea is, as an investor, to construct a portfolio that will do well in any market condition, whether it's high interest rates or low interest rates, whether is it economic growth or recession. So when the day comes when the AI stocks have a big correction, no problem, right? Because my non-AI stocks, my non-tech stocks will do very well and buffer it.
Okay, so now, since we are still on this topic of AI, right? And the earlier numbers that we cited previously was that a lot of all these hyperscalers are spending close to $300-400 billion on an annual run rate basis. And people are worried that, are they spending too much money? Is this really justified or not? So Adam, what's your view on this?
So a few things. I think, first of all, we are still at the early stages of this whole AI revolution. So remember that it started with large language models or chatbots. That was phase one. And now most people are using it already. But now we are going into agentic AI agents that are autonomous, right? And that's just the beginning. That will need a lot more compute power, right? It's just the beginning of that. And then right after that, we're going to have the whole humanoid robot revolution where almost every tech company under the sun is going to make humanoid robots. And that needs a lot of compute power, a lot of AI infrastructure. And then autonomous driving and robo-taxis and flying cars. We're just at the start of that. Then, of course, the concern is that, are the big tech companies overspending? I don't worry too much about that because the big tech companies like Meta, like Google and Amazon, they are making billions of dollars in free cash flow every single year, every single quarter, right? So like what Mark Zuckerberg said, even if they overspend, who cares? Because they make enough cash flow to pay for it, right? And this is very different from the dot-com bubble. In a dot-com bubble, they're spending a lot on all this optic fiber and stuff like that. And companies that had the dot-com behind their name were spending money, but they were not actually making money, right? But these companies today that are spending the money, they have the cash flow to back it up. So even if they overspend, who cares if they overspend? They can afford, let me put it this way, they can afford to lose the money. Just like Meta spent so much on the metaverse a few years ago that didn't work out. And Meta's stock price dropped 80% at the time. And I was buying because I said to myself, even if the metaverse doesn't work out, who cares? In fact, in my valuation assumption, I assumed that it would not work out, right? So that's why it's important that when you invest in companies that generate a lot of free cash flow, even if their bets don't work out, it doesn't matter because the free cash flow will cover it up very soon.
So maybe just to circle back to this entire discussion of where the markets are currently at, Adam, what's your thoughts on the upcoming movements of the S&P or the general indexes for 2025 and on into 2026?
I'm still bullish, like what Alson said. Okay, so number one, if you look purely at the technical charts, okay, so the S&P is on a very, very clear uptrend where the 20 exponential moving average is above the 40 EMA on the daily candles and the 50 moving average above the 150, which is a medium-term uptrend, and the price above the 200-day moving average. So what all these moving averages tell you is that the market is on a strong uptrend. And the old saying is the trend is your friend. As long as the market remains on an uptrend, the path of least resistance is going up. And of course, it doesn't go up in a straight line. It doesn't go up every day, every week, every month, right? It will go through wave up, wave down, wave up, wave down. But generally, the trend is up. So that's from a technical perspective. From a fundamental perspective, I also expect the market to continue going up because number one, companies continue to generate strong earnings, right? Why are they generating strong earnings? Because of gains in productivity. Because a lot of these companies that deploy AI are seeing an expansion in their profit margins. They are seeing higher revenue, profit growth. And then, of course, you have got the Trump administration that is, doing their tax cuts. They're doing their deregulation, and the tariffs again, are becoming more normalized. Okay, so unless there's some external exogenous event that we can't predict, like the aliens landing or something like that, the market should continue to push higher. And also remember that this is the third year of the bull market. So the bull market started in 2022 November. That's when the new bull market started. So we're in the third year of the bull market. And historically, the average bull market lasts about 5 to 6 years. So which means that if this is an average bull market, we've got about 2 more years left in this bull market, right? But bull markets have also lasted 10 years. If you recall, after the great financial crisis in 08-09, the bull market lasted from 09 to 2020. It was a 10-year bull market. So you never know. This could be another 10-year bull market, but worst come to worst, 5-year bull market, 6 years, we still have another 2 more years to go.
So also, I think in this current interest rate environment, where we're expecting the Fed to continue cutting rates, and in fact, we are also seeing the effects coming into it, where banks are cutting our interest rates on our fixed deposits. I think some people might be wondering, where should they actually park their cash today? The markets are all-time high, I'm scared, I park in relatively safer instruments, the rates are going down. What am I supposed to do with my money? So
Okay.
Adam, what do you have to say?
So yeah, you're right. So if your money's in a fixed deposit in Singapore dollars, I think it's less than 1% right now. If it's in US fixed deposit, I think it's like 3.6%. So where do you park your money? It depends on what you want. Do you want yield, which is dividends, or do you want capital gain? So if you want yield, I think there are still a lot of attractive investments. Like for example, the Singapore REITs. The Singapore REITs have rebounded quite a bit, but quite a number of them still have attractive dividend yields of about 5 to 6%. But of course, only buy the high quality REITs. The ones with got low gearing ratios, the ones that have got growing distributions per unit, the ones with growing NAV per share. And if you're wondering, hey, how do I know which are the good REITs? I'll talk about it during my webinar on income investing. And again, you can click to get the details below. That's one area. Another area would be bonds, all right? But again, you have to know what kind of bonds. And right now, if you look at bonds between, I would say, 2 to 4 year maturity, and you can also look at bond funds. Some of them are not bad. Some of the Sing dollar bond funds, I've seen one 4.45% dividend yield, and some of the US dollar bond funds 6% dividend yield. So still very attractive. And these are relatively pretty low risk, right? Remember that bonds are only dangerous if interest rates rise very fast. When interest rates go up, bond prices collapse. That's what happened in 2022. But now that interest rates have already peaked, I don't see them going up a lot more. In fact, I see rates going down. So as interest rates go down, bond prices go up even more. I think bonds are in a sweet spot, both corporate bonds as well as some of the government bonds, right? That again, you can still get 4 to 6% yield. And the other area would be private credit. And again, be careful. I only go for the highest quality private credit funds. And some are listed in the market, some are not listed in the market. In my webinar on dividend investing, I'll talk about that. And some of the private credit funds are now selling below the book value, which is very attractive. I've been buying a lot last few weeks. They are giving me a dividend yield of about 9, 10, 11% yield. So it's very attractive, but you have to know where to find it, right? That's what I'm going to share with you in the webinar. On the capital gains front, like I said, even though the market overall is at all-time high, I think there are very good, high-quality companies that have got good growth rates that are attractively undervalued. Okay, and some of them are in the not all of them are in technology. Some of them are non-tech, like industrial companies. And the reason why they are cheap now is because they are not AI exciting. So the market has kind of like disregarded them. But that's where we find value. So one example is this company called Waste Management. That actually their main job is to clear rubbish and recycle rubbish. Very boring, right? But very consistent growth rate. Right now it's undervalued and I've been accumulating that. Another one is Copart, which is very undervalued right now. It's got an 80% market share of the car salvaging market in the US. So there are a lot of these opportunities. And of course, healthcare is another example, right? Like United Health, we have been accumulating. Buffett actually accumulated as well. Maybe he did it after me. I think he did. And it's recovered quite a bit, but even then it's still undervalued. So there are still high quality companies that are undervalued in the market. And again, in my webinar, I'll detail how I find them.
Okay, maybe to round up this entire discussion, I want to talk a little bit more in terms of the entire AI narrative in the crypto space as well. So maybe Alson, can you share a little bit more in terms of, do you look at it particularly from the AI lens, or give us a feel or general sensing of the crypto markets today?
I think crypto right now, when I started in 2016 trading crypto, there is actually around 2,000 alternate tokens. Right now in today's crypto market, there's, as I last checked, 19,406 altcoins. So that's like 10 times more altcoins than 9 to 10 years ago. So back then, when money comes into the crypto market, right, a lot of them went into pump, even coins was being pumped, and that's what triggered the alt season. But in today's crypto market, right, a lot of the money that comes into crypto market goes into institutional great asset class, right? Right now, I think Wall Street has recognized Bitcoin and Ethereum, and most of the money that comes in goes into some of the big cap names. Very low amount of money is actually flowing into alts. And that's why right now you see that the alt markets is actually suffering right now. I think almost 99% of the alts are more than 50% from their all-time high. So moving forward, my game plan is for the crypto market is to be very selective, even for smaller odds, right? And to have more than 50% allocation in big cap names like Bitcoin, Ethereum, XRP, and even, for example, like as you mentioned, the AI narrative crypto like BitTensor, which is a decentralized AI infrastructure that they host many subnets, different AI projects targeting different use cases in AI. So I'll be looking out for big cap cryptos like this. And for smaller odds, I'm going to be very selective, right? Because I think that there's a chance that there may not be a full-blown alt season like 2016, but there will be very selective alt season from time to time in certain narrative.
Okay, thanks to all the mentors for sharing. So I think as we come to the tail end of part 1 of Black Market panel discussion, just to do a quick summary, I think firstly, of course, we've reviewed the first 10 months of 2025 and the trainers have shared their lessons learned. We've also explored the reasons as to what is leading this very strong market rally across the different assets. And more importantly, we answered the million-dollar question of how you should trade and invest in this AI bubble narrative market. So in the second part of this panel discussion, I'll be sure to get the trainers to share their outlook, game plan, and opportunities for 2026. So remember to stay subscribed and catch us in part 2. So we have a series of exciting webinars, so do join us live at the upcoming Black Market event, and we'll see you there. And this is CK from Piranha Profit signing off. Till next time, keep winning.